is maybe one of the largest and most exciting areas of on-chain finance. I mentioned earlier in a panel that Larry Fink spent most of his time talking about real-world asset tokenization. I found that fascinating in and of itself, that in a 30-minute interview, so much of his time was devoted to even thinking it through. In this panel, we're going to dig a little bit deeper, since we have so many really leading experts, both in terms of market infrastructure, but also from the regulatory standpoint. I'm going to let everybody do, starting with Sarah, to do their sort of name, rank, serial number descriptions of one another, and then we're going to hop right into the topic. So, Sarah.
Thanks. Sarah Breeden, Deputy Governor, Financial Stability at the Bank of England, and responsible for our work on innovation and stablecoins.
Hello, everyone. Ebony Thompson, City Solicitor for the City of Baltimore. Basically just means that I head the law department, and I've been spearheading a pilot for us to record over 228,000 of our properties on blockchain.
Good afternoon. I'm Peter Hughes, CEO and founder of Apex Group. We are a large asset servicer in 52 countries.
Okay, great. So as you can see, oh man, Edward, I'm sorry, man. I'm sorry.
No introductions, but I don't think that's
it was the great British accents that were lulling me into.
Sorry, very quickly. Edward, CEO and founder of zerohash. We provide stablecoin tokenization and crypto infrastructure to all sorts of financial institutions.
I was also thinking about some of the legal questions in the background about this. Okay, so let me just hop into this first with Sarah. So when you think about things, particularly from your perch, and I love that, your dual role. I mean, supervision and innovation. That's a very unusual sort of confluence of responsibilities over the Bank of England. Tokenization is obviously packaged in the conversation about markets and market efficiency, but there are lots of different kinds of RWAs. Where do you see the strongest use cases for real-world assets? And since you have two hats that you wear, where are the risks that you see to be the most worrisome?
So great question. And I can see use cases in many different places: retail payments, wholesale payments, cross-border payments, but in this context, settlement of financial market instruments. At the bank, we launched with the FCA, our markets regulator, a digital securities sandbox last year that provides a regulatory framework for the private sector to come and set up trading venues and settlement systems for tokenized assets. Now, this is exciting because we're bringing real use cases for real-world transactions in tokenized securities now. Although it's called a sandbox, it really isn't. These are real, live transactions. They're not prototypes. They're not experiments. We've got 15 firms in the sandbox so far, and counting. It's the established firms like Euroclear, HSBC, JP Morgan.
Never heard of them.
But the small guys as well. And what they're doing is setting up infrastructure to trade tokenized equities, corporate bonds, government bonds. And I think you all may know the UK government is planning to issue a digital tokenized government bond, a gilt into the sandbox, likely next year. And what this will do is create faster, cheaper processes in financial markets, fewer intermediaries, less operational risk, shorter settlement windows, and smart contracts automating processes like coupon payments. It's really good to see this happening real live now. The main risk I worry about, perhaps we can come onto this later, so I don't take up too much now, is ensuring that we have the right cash leg. What is the settlement asset that has the requisite safety and functionality to play the role of money in tokenized transactions? My view is that central bank money, our liabilities, must remain the settlement asset for the most important transactions in financial markets, even as we see greater tokenization. That way, we're not introducing potentially precarious and unnecessary interconnections in the financial system. And to the other part of my job, the financial stability risks. And that's why in the UK, we've launched a modernized wholesale payment system RT2 as it's known this year. Now, we don't need central bank money for all transactions, but having that platform there is helpful.
Well, there was a lot in that, and
We're doing a lot. I get really annoyed when people think the UK is behind. Anyway, and relax.
Yeah, I think when you that scope of action was really interesting, and I am going to get back to both the risk element and still the continue of that conversation as to what exactly is the settlement asset. And I already can hear in your answer, frankly, some evolution over the last couple of years from central bankers about how do you frame that question and what your analytical lens is going to look like. But Ebony, I'm so happy to have you here as well. So over at DC FinTech Week, what we really enjoy is having great perspectives from different sort of use cases. In the past, people who have been to the event will know, I mean, we've had everyone, we've even included like epistemologists on what is the nature of reality. We really have. People loved it in terms of online digital transactions. Your experience is very concrete, right? You are the solicitor for the city of Baltimore, and you went on a project of trying to truly tokenize real-world assets. Can you give us a little overview as to what that project was and what was your objectives in the city's lawyer thinking about digital assets?
Absolutely, excellent question. So this came about actually my first day with the city in January 2022, where we had a press conference and we were unfortunately discussing 3 firefighters that lost their lives battling a vacant property in Baltimore City, and it just collapsed on them, and they lost their lives. And Mayor Scott took this problem. At that time, we had as high as 17,000 vacant properties. And he said, I want concrete ideas, and I want everyone to bring their ideas. I don't care what agency you're from. And that is what gave the law department an opportunity to weigh in on what we believe is not only just a housing issue, but a public health issue. And I proposed to them that we would, record our properties on blockchain. It started out with our vacant properties, but it was so popular that we did the majority of our properties, over 228,000 we have, and now with the hopes of tokenizing them, and I know we'll go into that a little bit later, but it was really about really combating a public health crisis, and then at the same time, of course, nationwide, Baltimore is no different than that. We have affordable housing crisis as well. And we saw that these vacant houses were sources of blight, sources of crime. So they were connected to everything. And we were we couldn't say we were going to be serious about solving this problem if we weren't going to utilize every tool that was available. And we thought that blockchain was a critical tool, not the silver bullet, but if you build around that is one piece to allow us to tackle this problem. And we're down to under 12,500 in trying to drive that number down. But that was the source of how the head of the law department came to spearhead a project in housing.
Yeah, it's almost as kind of unusual as you'd think if you had like a central banker doing supervision who was interested in innovation. I mean, what are they going to come up with next? So when you are just sort of getting a sense, I think, as to sort of how these issues are seeping into different policy areas, and Peter, coming to you now. Apex is a major company, works across lots of different asset classes and services. I've traveled around a lot recently in opening up conferences in the Middle East and in Latin America. And one of the things that both regulators constantly are telling me, but also financial market participants, is that they look at what should be tokenized based off of national advantage, relative advantage, economic advantage, but also where the market is in terms of their ability to take on board and understand different products. So when you think about credit, commodities, real estate, they're all showing different forms of momentum, different parts of the world. But how much of it is real in real world assets? Where do you see the hype? Where do you see the possibility? Where do you see the practical upshots?
Yeah, I think it's difficult. There is a bit of hype out there, and it's great to see a real use case making a difference. In our world, we deal with a lot of asset managers globally, and they're trying to tokenize, whether it's assets in their portfolios or tokenize their fund shares to create extra distribution. And a lot of these projects are really the smaller end of town, so they don't actually get the critical mass because they haven't got the institutional branding behind them. But just really in the last sort of 4 or 5 months, we have a part of our business called Apex Digital, which is everything we do on chain. That has just really expanded from 30 opportunities to 150 in the last 3 months. And mostly it's around really what other asset managers trying to do to enable their distribution to be reformatted. So reformatted, I mean, with a tokenized money market fund, instead of being a normal money market fund, this trades 24/7/365. So you can imagine the value of actually that yielding all the time on chain, and then you can collateralize against that. So some really strong use cases, and we've got some really big institutions looking at that now because of the perpetual trading, but also the collateralization piece to it. There is a real shift, I think, to thinking about how do we, for example, take a leading asset manager in their private credit fund. I can't invest into a BlackRock private credit fund. It's a $5 million subscription. You get your money back in 10 years' time. That's disappointing because actually it's quite a good product. But actually, if you can tokenize that and get that on-chain and a $10,000 subscription, everyone can participate in that. And I think that's going to be really valuable, but it hasn't happened yet. It's about to happen, and you get DeFi exchanges are happening to be able to trade these tokenized solutions. So it's when it becomes institutionalized, and what we call that is digital assets rather than what people are used to talking about, which is crypto, which is for the retail trading. And we're trying to institutionalize, move it away, make sure there's clean AML across everything we do. Then it'll be used by corporates, wealth managers, retirement, even ultimately, when regulators are comfortable, retail. And that opens up huge doors into new markets.
And the hypey areas. So we're hearing is the hype, if there's hype, I think that's a good question. Like if there's hype, where exactly it resides. And the reason why I'm asking again, yes, because this, again, Larry Fink droning on securitization, tokenization, real world assets is so unusual because he was all for it. Where do you think people get over their skis?
Just with assets that they can't actually sell, they're trying to put into a different form. So you get tokenized, wine, art, whiskey, those sorts of products.
Mild Jordans.
Where it's not really legitimate in my mind.
Great. Well, then that gets to a great question. CEO of zerohash to ask Edward here. So what are the attributes in your view then as to sort of products that are best for tokenization? What are the kinds of things that you strategically think about?
Yeah, so I think what's really important in this discussion is that we don't view tokenization and non-tokenized assets as binary. These things can move between one and the other. So I'll make that really tangible for you. So with stablecoins, I believe that they are the most powerful mechanism to move money, what you may term money in motion. But objectively, right now in the US, if you are able to hold a dollar balance, money at rest effectively, a dollar balance, a non-tokenized representation, is objectively better for pretty much every person in this room. The reason why? In the US, you will not be able to earn interest on that tokenized dollar. You are taking private credit risk against a company as opposed to the US government. And you're not insured on those balances. So I think that this distinction of what is powerful around tokenization and what's not, I really think it needs to be less binary. Clearly, with a dollar, the ability to move 24/7, 365 instantly anywhere in the world is incredibly powerful. And that's where we've seen a huge uptick. So one of our fastest growing products is what we call our account funding product. And this allows people to move money into, for example, regulated clearinghouses or regulated broker-dealers, or indeed regulated funds like Biddle and Franklin Templeton that we power, the ability to move that from anywhere in the world, 365. And that's incredibly powerful as you see the drive of tokenization, you see the rise of 24/7 marketplaces. So for me, it's about when in the life cycle of an asset does it make sense to be tokenized? And I think that matters. And where we're seeing where it really matters is where you need to move value instantly, globally, 24/7, 365, cheaply.
Super interesting, helpful information. I guess I'll shift it back to you. Sarah, particularly when listening to this, and for that matter, Governor Waller, who had sort of interesting comments to make about European approaches to crypto assets. What kinds of policy frameworks and guardrails help to enable what Edward's sort of pointing to? And what do you think is really necessary if tokenization is going to, again, looking at your dual mandate here, is going to scale quickly, but also address some of the risks that you were intimating in your first set of comments?
So what's absolutely fundamental here, Chris, is that we have safe and functional settlement assets that can support the activity that we've just been talking about. In some wholesale markets, settlement in central bank money is important for financial stability. But in other markets, tokenized deposits and stable coins have got an important role to play. But it's on us as the regulator to make sure that those stable coins are safe. One of the things that we have been focused on as we've been designing our regime for systemically important stablecoins, those that are used widely in the economy, is to make sure we're designing a regime that's fit for the future uses, not just the current uses. So supposing these uses take off, they're widely used, kind of how do we make sure that money is safe? So what we've been doing at the Bank of England is offering to be the banker to the coin. The coin doesn't have to go and try and put its balances with the institutions it's competing with. It can place its money with us. We're offering to be a lender of last resort for it so that we can be confident that the pound in the stable coin is worth the same as a pound in a bank account, a pound of central bank money, a pound of tokenized deposit. And I think that is really important for ensuring that as these coins scale, they are able to perform the function of money. We could have a different regime to start with, but I would worry that as they scale, we would then want to change the regime. And as we've learned in technology all over the place, retrofitting regulation as use takes off does not work. So we're setting out a regime now that's fit for the future.
Retrofitting regulation doesn't work. That's I don't know, maybe fits on a t-shirt, but pretty darn close. Very interesting. So again, I like to make these things very, very tangible. And Ebony, when you're sitting here as the lawyer for the city of Baltimore, right, and you're hearing all these conversations, you have a much more tangible sort of risk-reward calculation that you have to make, right? On the one hand, you can talk about financial markets, but you're also talking about real-world applications of real-world assets, right? How exactly did you go about thinking through and even implementing the, putting these blighted assets on chain? What efficiency gains were you looking at? And from the risk perspective, what, if any, sort of questions were in your mind? I mean, obviously for a lawyer to hop into crypto assets or real-world assets couldn't have been that easy.
Oh, absolutely. I won't disclose how many people laughed at me when I brought up this idea, and it nonetheless coming from a lawyer, their top lawyer. But when I saw the need where we're looking at these vacant properties, we had 17,000 of them, and the majority of them are not owned by the city. So we had to first implement a in-rim track within the circuit court so that we could actually get these through the process of ownership so that the city could actually handle it faster than the foreclosure market, which would be 2 to 3 years. Whereas in-rim are properties that are underwater, meaning that they have more liens than they are worth, right? So the amount of time we were able to cut that from 2 to 3 years, take them off to 4 to 6 months. So we're saving time there. The other piece where we were saving time is since the city doesn't own that property and they have to acquire it, we're not in the business of rehabbing the property. We still have to resell it to an investor, and then that investor is going to rehab it and then sell it to the end user or the landlord. So our properties are changing hands relatively quickly, 3 times within maybe a year and a half. So why are we doing title searches each time, right? Why are we not looking forward instead of going back 50 years every time we have to do that? Especially when you have a housing crisis and you have a blight problem and you have 17,000 that you're trying to drive the number down. It just didn't make sense, especially legally. I was like, this doesn't make sense. So in terms of the efficiencies, the government could get behind that. And I think when you present, especially in municipalities, where I think if you're looking at mass adoption, you're going to need municipalities and counties to jump on this, you have to look at where they are hurting, right? And this is something that's concrete that everybody could get behind. But then as you expand, because that's not where I wanted to go, I wanted that to be the beginning. We know that Baltimore is the birthplace for redlining. And we know that a lot of the 17,000 properties, the majority of them are in these disinvested neighborhoods that have suffered from decades of banks not lending to them. And what we want to do is we want to ensure that the same abuses are not repeated as we come up with products to combat that problem. So to build those guardrails and to be able to be, usually on the lawyers, like on the back end, like when we have the opioid settlements and we have record settlements for opioids, record settlements for ghost guns, the lawyers now are transitioning now to encoded on the front end, the rights and the responsibilities on the front end, so we can say that local investment is first. The people that have been disinvestment and lived through that for decades have the opportunity first, and we can encode that in the beginning. And then we're basically encoding equity. And that not only helps us with our issue in terms of the blight, but it also helps us in terms of the disinvestment that we're suffering from in the city as well.
Yeah, it's going to be really interesting because, because I think you're really on the earlier end of things, but ultimately, if you really try to tokenize that asset, to think about what, you're sort of hinting at what liquidity looks like, but ultimately you're going to need, even more infrastructure to support that and to really get it going. I think just big meta question for Peter is that I think right now. And you see it whether or not it be with Ebony's work, whether or not it's Sarah's work over at the Bank of England, whether or not you see it with other smaller projects, in the sandbox and the like. There's this question of experimentation. And how do you sort of tinker with this new technology, tinker with tokenization in a way that ultimately allows you to move past a pilot into broader adoption for real world usage, and also for financial markets, for trading, collateralization, and the like. Do you think that tipping point is going to be driven by technology, clarity on the regulatory end, because we're getting some now, or is it some kind of new market demand? How do you weigh each of those sort of different drivers?
Yeah, I think it's mostly regulatory. I think once the technology exists, but I think people have built products traditionally for the retail side of things, evolving from the crypto space, whether it's some really good stable coins like USDC. That's on unpermissioned chain, and it's got a proof of reserve monthly. Well, that's a retail product. Actually, if regulators then evolve that to say, well, actually have a daily proof of reserve, so the assets are sitting there, it's on permission chain, so that it's clean money going through it, absolute constant AML around that, then that becomes a quality product that can be used for corporate treasury. And I think that's the inflection point. It's just a little lift will allow regulators to feel comfortable that it's safe. And that's not much. I mean, the technology exists to do it, and it's just a little tweak. And then once, I believe in 5 years' time, that corporate treasury will all be stablecoins of different types. And yes, there are some people out there who think it should be Bitcoin. I'm not one of those, but stablecoins absolutely, especially if they're yield-bearing, and that's coming through quite quickly.
Can I just add, I'm supposed to only ask questions, but to maybe an observation, one thing that I've seen is that the financial institutions themselves, even if a liquidity pool is unregulated, even if its venue is unregulated, the financial institutions are, right? And even if there's no explicit permission or lack thereof, there are operational risk charges that can apply to the financial institution in terms of how they either custody, collateralize, or whatever they're doing. There are these kinds of things that are in the back of their head, regulatory clarity or not. And I kind of, to double click on that, I think providing the clarity is useful whether or not things are explicit or not. The financial institution, if you want to institutionalize the trading in the markets, that seems to be super important. We actually do have a little bit of time. Don't worry. For you, Ed, it's built in. It's built in. Okay, I'm going to try asking this question from another vantage point. What real-world asset will ultimately be mainstreamed first, given this question of regulatory clarity? And also 5 years from now, does that change? In other words, does the leading position of what is sort of, let's call it the anchor real-world asset, do you expect to see, let's call it the market reality catching up with wherever the regulation ends up first or second? Eventually, the best use cases are going to accelerate.
Yeah, so maybe just dovetailing on the regulatory point, I think what's really important is looking back at history. So one of our largest investors is Interactive Brokers. And Thomas, the founder, made his money effectively by the electronification of markets. And when he first started, they literally did not want algorithmic trading. So what he built was a finger that would plug things in more quickly because that wasn't written into the rules, right? So we were fearful of electronification. We're always fearful of technology to some degree because it's unknown. So I think what the SEC has done in the US is really great. The underlying database doesn't ultimately change the underlying. And I think that's a really important piece. And regulators, it's not just lawmaking which matters. It's also the implication that regulators give. Right? What I think happened over the last few years in the US was regulation by rulemaking, regulation by enforcement, and regulation by implication. So these three things have all been pulled back, and I think that the US is in an unbelievable position to take the lead. I would say that we're not in a hypothetical world, right? Dollars are tokenized, and maybe this will just prove a point. So dollars, tokenized dollars are used all around the world. We're all excited. We keep talking about them. But let me talk to you about the user experience as it exists today. Today, you have to decide on how many chains are, so you have to decide which stablecoin do you want to send somebody. So if I'm sending you a stablecoin, do you want USDC, do you want USDT? That choice is going to explode. Number two, on what chain do you want it on? And then thirdly, I need the native asset to send that, and then that needs to be interoperable with the asset that you want to receive and also the chain that it needs to be received. So the UX friction today, the usability, is super high. And despite that, stablecoins have grown significantly. So that, I think, proves the value proposition. And I think the biggest impediment to growth across all of the applications, whether it be dollars or tokenized yield-bearing instruments, is usability. As we bring the usability frictions down, the adoption of this is going to explode even more and is going to accelerate even quicker.
Can I be really cheeky?
We have like FINRA guy, and he's like super powerful. Like, wait.
One thing, interoperability, ensuring things can interoperate with one another will help drive down those frictions. Second thing, the more the regulators and the private sector work together, the more that we convene and try and look at practical use cases, the quicker we'll be able to move.
Well, it's good, because as I moved right now to FINRA, I didn't know if I wanted to use the word explode as like the last thing for our conversation, but this was really interesting, extraordinarily informative. Right now, I am delighted, as we move off stage, to welcome AWS's own Olivia Peterson. She's the person who literally made all this available to us, and just was a treat. And she'll be with Greg Ruppert, the Executive Vice President at FINRA, who is also hosting their own piece of DC Fintech Week on October 17th, which is great. And it's called Investing in a World with Social Media Influencers. So I guess we'll all now move off stage and welcome the next session. Thank you.